We are doing a presentation on Alltel Corporation done by Michael Hanger, Jordan Joint, Max Bick, and Ying Tan. Starting by the overview of the transaction. Alltel announced to be sold on May 28, 2007. It was sold to TPG Capital and Goldman Sachs Capital Partners on November 16, 2007 for $27.5 billion at $71.5 per share, a 10% premium over Alltel's previous closing price. Verizon Wireless bought Alltel for $28.1 billion in 2008, driven by Goldman Sachs and several other large banks. This was the largest telecommunication buyout to date, and it is still the largest top 5 LBO deals in history. Moving on to the brief description of Alltel. Alltel Corp was founded in 1943 by Charles Miller and Hugh Wilburn in Arkansas as Allied Telephone Company. The company was specialized in installing cabling and poles for telephone companies. The company merged with Mid-Continent Telephone in 1983 and became known as Alltel. In 1996, the Telecommunication Act that deregulated the industry allows more competition to enter the market. Alltel began as a serious competitor after that act, and at the end of 2005, Alltel became a wireless-only company. Another fact that is interesting to notice is that Alltel had 12 million customers prior to the LBO, and it was only roughly 1/5 as many as Verizon and AT&T individually.
Alltel began attracting a lot of attention after splitting off their wired phone service segment from their wireless business segment. Alltel chose to focus on their wireless segment, which was a fast-growing market. Due to the growth of the industry, moving to a wireless focus from a mixed focus increased revenues and brought focus onto Alltel as a possible buyout potential as they managed to grow their client base by 11%. They increased revenue by 13% and increased their operating income by 21%. The increased gains enabled Alltel to continue to grow and remain relevant in the sector. The LBO participants were Goldman Sachs, Texas Pacific Group Capital, and Atlantis Holdings LLC. Goldman Sachs is a private equity and mezzanine investment fund. At the time of the Alltel LBO, they had $56 billion in investment commitments. Goldman Sachs Capital Partners is an arm of Goldman Sachs that is used specifically for the negotiation of private equity deals and transactions. Goldman Sachs Capital Partners has global operations and specializes in large and complex business opportunities, offering value through their ability to leverage large quantities of funding. Texas Pacific Group Capital is the global buyout group of TPG. TPG is a private investment firm which was established in 1992 and, at the time of the LBO, had an asset value of over $30 billion spread throughout the globe. They have offices in the United States, China, Australia, Japan, Russia, Singapore, and India. They have engaged in numerous LBOs in various sectors and in various industries. Atlantis Holdings LLC was created by TPG and Goldman Sachs for the specific purpose of acquiring Alltel. The company didn't exist prior to the start of their negotiations. Rumors of Alltel being sold started in late 2006 when a Wall Street Journal article started to speculate on the company's future. Alltel CEO Scott Ford furthered suspicion when he told investors that the company was looking into a broad spectrum of possibilities when referring to the future state of the company. Before TPG and Goldman Sachs came together to buy, Alltel was discussing potential sale options with several interested parties, both strategic and financial. At one point, Alltel's board of directors were considering taking the company to auction rather than doing a private, negotiated sale, but decided the risks were outweighed by the potential benefits, specifically risks to investors. These risks were mostly fueled by the risk of companies using a broad spectrum of valuation methods, which would cause problems for stockholders and the company's valuation, as they could undervalue the company from what they believed it was worth.
For the sources and uses of funds, the top bullet point is equity, and that equity came from private sponsors. And below on that list, that is all primarily forms of debt received from Citigroup, Goldman, Barclays Bank PLC, Barclays Capital, RBS Securities Corp, and the Royal Bank of Scotland PLC. And the uses of these funds, $25 billion went towards stock and option holders, $0.4 billion went towards refinancing and repaying debt, and $0.9 billion went towards merger fees associated with the LBO of Alltel. And that donut graph down below shows how the high percentage of uses of funds went towards paying stock and derivative holders. For the composition and size of financing, $4.6 billion was equity and $23.2 billion was debt, and those numbers are up to per the terms of the contract. There was a secured loan for $14 billion, a secured revolving line of credit for $1.5 billion, an unsecured cash bridge for $4.7, and for $3 billion there was an unsecured PIK. The capital structure of the deal was 16.5% equity and 83.5% debt. The pie chart up top shows equity in green and the various forms of debt in red. For the acquisition premiums and the multiples, the buyout occurred at $71.50 a share, and that ended up being a 9.6% premium to the previous close of Alltel at $65.21. And in 2006, the Wall Street Journal posted an article speculating a takeover, and at that time, Alltel traded at $58.31, which would imply a 22.6% premium at the $71.50 buyout level. The transaction EV over EBITDA was 9.2, the LBO debt over EBITDA was 8.5, and the average for 2007 for large LBO loans was 6.2x for the debt over EBITDA. So Goldman and TPG did pay a premium relative to the private equity industry in 2007 for Alltel. And at the time, Verizon traded at 18 times earnings and AT&T traded at 15 times earnings. The LBO valued Alltel to trade at 25.6 times earnings, or that was their PE ratio, so it was an expensive deal relative to industry rivals.
Alltel had no major tax or accounting issues. Leading into the LBO, their public accounting firm, PricewaterhouseCoopers, produced clean audit reports that demonstrated Alltel's solid margins and consistent revenue growth. All three parties projected steady revenue growth and EBITDA for Alltel after the LBO. TPG Capital and Goldman Sachs had to follow a few regulatory and legal guidelines in order to acquire Alltel. The majority of shareholders needed to vote to accept the LBO agreement. Neither company could have restraining laws or orders in effect that would prohibit the finalization of the merger. They needed to provide the FCC and Department of Justice with information about the LBO before it occurred in order to get HSR approval. In doing so, they would be requesting approval from the FCC in order to take control of Alltel's assets, and from the Department of Justice, who can take action to block deals that it believes would dramatically lessen market competition. The Williams Act required the two bidders to sync the details of the target LBO offer in their filings with the FCC and with Alltel. Those details included the offer terms, cash sources, and their plans for Alltel after the acquisition. TPG Capital and Goldman Sachs wouldn't be able to close their deal until the waiting period outlined in the HSR Act had passed. This was usually 30 days after filing their reports. Some of these reports included the S-4 form, which provided details relating to their share distribution, amounts, terms, and other information relating to the Alltel merger. Representations and warranties that were both true and correct had to be prepared by all three parties. Any misrepresentations of warranties could lead to the forfeiture of the acquisition of Alltel. All three parties also had to write agreements for the acquisition and had to perform all covenant agreements outlined in their merger agreements. Lastly, TPG Capital and Goldman Sachs had to deliver an officer certificate with respect to the satisfaction of the conditions above to Alltel at the closing of the deal. If, before the deal was finalized, any party were to terminate the merger agreement, they could be charged a termination fee of $625 million. In June 2008, Verizon announced that it would buy Alltel for $28.1 billion. They would pay $9.1 billion in equity and acquire the $22.2 billion Alltel had remaining in debt. Alltel had had difficulty producing enough free cash flow to get rid of the debt from the LBO, and TPG Capital and Goldman Sachs were never able to sell this debt, so it stayed on their books until Verizon's purchase. On Verizon's side, this deal forced them to divest 105 markets in 22 states, which they sold to AT&T, 79 markets in 2009 and 26 in 2013. Even with this divestment, Verizon still became the largest wireless network in the US, overtaking AT&T in market share.